Welcome to Indianomics on the all-important first quarter GDP numbers. The first quarter GDP at 6.7 has been mistakenly described as the lowest in 5 quarters. If one looked at the gross value added or GVA number at 6.8, it is actually stronger than the previous quarter's 6.3%, that is Jan-Feb-March quarter. And yet, whether it is GVA or GDP, it is not touching the aspirational 7% mark or the Reserve Bank's forecast of 7.1%. To understand the Q1 growth numbers and the likely trend for the full year, I have with me an elite panel of economists. Joining me are Samiran Chakraborty of Citi, Sonal Varma, the Managing Director, Chief Economist at Nomura Financial Advisory, Abhishek Upadhyay, Senior Economist at ICICI Securities Primary Dealership, and Madhavi Arora, Lead Economist at Emkay Global. Ladies and gentlemen, thank you very much indeed for your time. Samiran, let me start with you. Should we call this a good number? Whether it's 6.7 or 6.8, it's falling short of the aspirational 7%.
Good morning, Latha. I think the way we have looked at this number is that it's the internals of the numbers are slightly better than what we had probably anticipated. There were two distortionary effects in this quarter, one from the elections, the other from the heat waves. The election impact primarily would have been felt on the government consumption expenditure and the heat wave impact on agriculture. Now, if you look at these two components only, the government consumption expenditure grew at minus 0.2%, so contributed basically 0 basis points to GDP growth. And agriculture contributed about 30 basis points to GDP growth. Now, for both of them, the historical average contribution is about 30 basis points and 60 basis points respectively. So if you think of some sort of a normalization of these two factors over the next couple of quarters, then that gap between the 7% aspirational number that you were talking of and the reported number, that gap could easily be bridged.
Okay.
So our sense is that we should be going back to the 7% print very soon once these two effects normalize.
Okay, I'll come to you on when you see that normalizing. But Sonal Varma, we have your report, and you are actually forecasting a lower GDP. You've brought down your forecast.
That's right, Latha. We've cut FY25 from 6.9 to 6.7. I'd agree with what Samiran has said in terms of internals being better than the headline, and that some of the effects, particularly government spending, is going to normalize in the coming quarters. But I think that needs to be seen in the context of what's happening more broadly. And there are 2-3 things to keep in mind here. One is, in our view, the urban consumer side is actually slowing. In fact, I'd point out most of the high-frequency data we've got for July and now for August have been weak. Passenger vehicle sales negative. We are seeing inventory build up. Medium and heavy commercial vehicle sales contraction again in the month of August. Cement demand weak. So we are seeing signs of softness in high-frequency data. We think one, credit growth is going to moderate, and some of the excess consumer demand on the urban side is going to moderate. Second, the big boost to GDP from corporate profitability because of lower input costs, that's clearly behind us. And therefore, GDP growth is likely to be lower and probably closer to GVA growth going forward. And third, I think global demand actually is soft, whether it's China, Europe, or even US on the labor market side. Things are slowing at the margin, and that we think is also going to be a headwind. So while the government consumption, government spending, and agriculture-related activity will rebound, it's going to happen in this backdrop. And therefore, we think it's quite likely that GDP growth and GVA growth remain in the 6.5% to 7% range in the next 3 quarters. So we see it extremely unlikely that GDP is going to be at 7 or higher in FY25.
Okay. Abhishek, on that note, let me come to you. I was pretty elated by the private final consumption number coming in at 7.5% almost. It was just 4% if you take the average of the last 4 quarters. shouldn't one be therefore banking on better rural recovery leading to a better multiplier effect?
Latha, we think, I mean, the 4% private consumption growth in second half last year as well as for full year was understated. Typically, there are measurement issues when you come to estimating the GDP internals. And if you look at the contribution of discrepancies, which was as high as 52% to overall GDP growth last year, that makes it very difficult to really interpret these private consumption growth numbers with any sense of confidence. So we think true consumption growth would have been higher, and you would get that sense if you look at two-wheeler sales, which are up uh, 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 14% last year,
Yes.
passenger vehicle sales up 22% last year. So with indicators of discretionary consumption doing reasonably well, 4% growth looked somewhat basically an anomaly.
Okay.
So while growth has picked up there, we think this acceleration is also exaggerated.
Okay.
That said, we do see signs that consumption recovery is broadening out. If you look at the social services growth component on the GVA side, you don't get that breakup separately. But if you overlap the government consumption expenditure on the GDP side and view the public administration, defense, other services on the GVA side, you see signs clearly that overall consumption recovery is broadening out. Yes, high frequency data this quarter, last quarter was mixed. Urban consumption seems to have slowed down a bit. But overall, theme wise, with inflation slowing down, with uh, uh, rainfalls, rains also recovering from July onwards, we see reasons for cautious optimism on the consumption front.
Okay, that's what I would think because the PMI data actually has been reasonably strong. I mean, you can squabble about it month on month being here and there. And what about the August two-wheeler? It's really strong, the TVS and other numbers that we have got. It is only CV and which is not showing growth. So can you weigh in on that, Madhavi? Would you agree that consumption actually has recovered and maybe, a stimulus for the coming quarters?
Hi, Latha. Perhaps the most encouraging news from the GDP data was how private consumption actually has jumped up. In fact, it converged with the GFCF. And in last year, it almost averaged close to around 4%. And this print was pretty encouraging when you saw 7.4% in the first quarter. While this is very encouraging, one needs to see this trend sort of sustained because one thing is there that the quarterly expenditure data is extremely volatile. And as I know other panelists were also mentioning, even as the rural consumption is firming, when you're looking at these two-wheeler sales and FMCG sales, which are now moved by the rural sector, there are clear signs that the urban consumption is slowing. So I think that would be the next lever to watch out for because while there's a convergence that we're seeing between consumption and even capital formation, we'll have to see whether that continues. For that matter, we'll have to actually reckon the fact that much of the GFCF has been essentially moved by the government capex
Yes.
and real estate. For the corporate capex to fire, especially in the world which is flooded by excess capacity of Chinese economy and lower demand visibility, it has to be really seen whether we see continuation in GFCF which goes beyond the government sector. And for that, I think private consumption and exports will have to fare comfortably well for the coming quarters for the GFCF in the private sector to actually fire off.
Okay, got that. GFCF, by the way, economists say that they mean capital formation. Actually, Samiran, can you weigh in on that? You pointed out that government government expenditure contracted by 0.2% in the quarter under review. But, public administration, that number was high, 9.5% it grew. And as Madhavi points out, capital formation is 7.5%. Even though government spend, we know from the fiscal data, it was 35% lower for April, May, June. So are you encouraged that private capex has picked up?
Absolutely. I mean, the 0.2 number, by the way, is government consumption expenditure, so that does not take care of the capex part. But the capex was down even more, as you pointed out, in the monthly fiscal data that we get. So despite that, if we are seeing this much of investment growth, then either it could be the private corporate side or it could be the real estate side, the household capex. Now, our hunch is, looking at the construction sector data, that there is a significant increase in the real estate side as well, because otherwise you wouldn't have seen a construction growth of 10.5%, despite some of the internals of the construction sector, some of the proxy indicators not being that good, like cement demand has been weak for the quarter. Despite that, we have seen a very high construction growth. And I will connect that with the household capex. But still, I would say that private capex was holding up. Otherwise, we wouldn't have got a 7.5 kind of overall investment growth.
Okay. God, that seemed encouraging to me as well. Sonal, would you be at least convinced that consumption is at least on a recovery mode, as is private capex?
Latha, I think, yes, consumption should, on aggregate, do better. And lower inflation itself is actually a big positive on the rural side. So I think what we're basically seeing is a rebalancing under the surface. And particularly this rural recovery theme does have more legs, for various reasons, including lower inflation and better production, for farmers. Urban side, though, I think is likely to soften. It is more discretionary, more sensitive to credit availability, and that aspect we think will soften. But on aggregate, I think inflation coming down itself is a positive for consumption. Private capex side, Latha, I think we need to split it into government, private, corporate, and the real estate side. So the government side is where we should see a pickup and a catch-up post-elections. And we did see that in the July capex data from the central government, which was up over 100% on a year-over-year basis. So that component should pick up. The housing side as well, there are still a lot of tailwinds, and we do think housing-related investment will pick up. The private corporate side, though, is where, we would describe it as still quite mixed. I think, yes, capacity utilization is picking up, but if you break that down by different sectors, it's fairly concentrated in a few sectors. And the global backdrop to us does not look conducive for a broad basing of private corporate capex recovery. So a lot of changes beneath the surface, Latha, both in terms of consumption as well as on the investment side.
Okay, a point taken, Sonal, but I have to take a mandatory break. There are some very important questions left. Will we make it to the 7% mark? What factors can help us, private capex and consumption? And how will the Reserve Bank interpret this number in terms of rate action? All those questions to my guests after a very short break. Stay with us.